Hello, everybody, and welcome to today's Dynamics 365 Tech Talk. Today's topic is Inventory Accounting Models in Dynamics 365 Supply Chain Management. My name is David, and I'll be your moderator today. We're broadcasting this session through Teams live events, and the audio can be heard through your device speakers. This session is being recorded on behalf of the Microsoft Corporation. When you join this event, your name, email address, and/or phone number may be viewable by other session participants in the attendee list. By joining, you're agreeing to this experience. The recording will be made available on the Tech Talks Community Dynamics page within 5 business days. If you have questions for the presenters or need support, please use the Q&A panel located on the right side of your screen. Our presenters will be responding to your questions in chat during the Q&A segment near the end. Thank you for your patience during these announcements. Presenting for us today, we have Ann Krupke, Senior Fast Track Solution Architect, and Rachel Profitt, Senior Fast Track Solution Architect. Ann, over to you to kick us off today.
Thanks, David. Welcome everyone to the second installment of our Tech Talk series on inventory costing in D365. This session is about inventory accounting models. For those of you joining Rachel and I for the first time, welcome. For those of you who attended our first session and still decided to come back, we applaud your courage. I'm Ann Krupke, one of your presenters for today. I'm a Senior Fast Track Solution Architect on the SCM team here at Microsoft, and I'm super excited to be back again talking about costing with you all. Please feel free to connect with me on LinkedIn or contact me if you have any questions or feedback after today's session. I'll let Rachel introduce herself next.
Thanks, Ann. For those of you that don't know me, my name's Rachel Profitt. I'm a Senior Fast Track Solution Architect on the Americas team. I've put my contact information here on the slide, and I do invite you to follow me on Twitter, check out my YouTube channel at Dynamics 365 Unbox, connect with me on LinkedIn, or check out my blog at dynamics365lady.com.
This is the second Tech Talk in a series of 6 Tech Talks that will dive into the details of inventory costing in Dynamics 365 supply chain management. In this Tech Talk, we will be focusing on details and examples of various inventory models available to us in the system. Today's session, however, will not cover standard costing, which will be covered next week in our session on standard costing in the costing series sheet. We continue to build on the costing logic in Part 4 by diving into production costing. Then in Part 5, we will review the inventory closing process and wrap up the series with a spotlight on the new global inventory accounting add-in. Part 1 was recorded last week, and you can find the recording on the Tech Talk Dynamics community page. Before we get started, we're back again with another riddle of the day. Today's question is, why was the accountant so popular? Post your answers in the chat and we will reveal the answer at the end of this presentation. Let's take a closer look at our agenda for today. We will start by reviewing the different high-level costing methodologies in D365 and then dive into the actual costing inventory models in more detail, with examples and diagrams indicating their impact on costing. Then we will switch gears to discuss the average costing inventory models and how they work. We'll then take a detailed look at how you can use marking with periodic costing models as a means to override the heuristic of your inventory model and use an actual cost. We will follow that with an overview of default costs and wrap up our session with the do's and don'ts of inventory models in D365. Let's get started with a quick overview of the various costing methods available and considerations for selecting a costing model in your implementation. In our previous Tech Talk, we walked through a basic distribution inventory flow to discuss the core concepts of costing terminology. In this Tech Talk, we will take this flow and look at it as it repeats over and over, resulting in multiple receipt and multiple issue transactions. For the sake of simplification, we will summarize this flow into its 2 main parts, the purchase, which is the receipt transaction, and the sale, which is the issue transaction. Now let's look at what happens when we have multiple transactions occurring over a certain amount of time. The gray arrow picture here represents our timeline. In this period, we have a series of receipt transactions represented by the purple arrows here. Each one of these receipts has a potentially different purchase price, meaning that different quantities of our inventory could have different cost values. When we look at our issue transactions through the period, we will need to figure out how to take these potentially varying cost values of our receipts and translate them into the cost of each issue. This is the purpose of assigning a cost model. We will need to take the sum total of our receipt costs and have them equal the sum total of our issue costs, but how each individual issue will be costed is based on the model we choose. In this next slide, we will talk about the different strategies we can use for costing. There are 3 main costing methodologies or strategies supported by Dynamics 365. The first methodology is actual costing. As this chart shows, the strategy here is to assign the cost of the inventory issued based on the specific cost of that inventory's receipt. Actuals costing is very common in industries that have highly variable costs who want to see this reflected from transaction to transaction. The next methodology is average costing. The strategy for this method is to assign the cost of inventory issued based on the average cost of the receipts instead of assigning a specific cost. Average cost is very common in the retail industry, for example, as well as other industries where the cost of individual transactions matters less and the cost trends over time matter more. The last methodology is standard costing. With this strategy, we assign both the receipt cost and the issue cost based on a predefined amount for that item. The scenario is very commonly used in manufacturing industries or industries where the cost price is normally very stable. Within these 3 methodologies, we have 7 different inventory models we can choose from in Dynamics 365. In this slide, we've listed out those different cost models available and grouped them under their corresponding cost strategies. We have FIFO, LIFO, and LIFO date in the actual costing bucket, moving average, and weighted average date in the average costing bucket. And lastly, we have standard cost in the standard costing bucket. In this Tech Talk, we will cover each of the models in the actuals and average costing strategies, and we will cover standard costing as part of the next installment in our series. Now I'm going to pass it over to Rachel to talk about actual costing.
Thanks, Anne. Let's go ahead now and double click and take a closer look at each of the costing methods for actual costing. We'll also take a look at some examples with and without physical values selected on the item model group. When you use first in, first out, or FIFO, the inventory produced or acquired first is sold, used, or disposed of first. During the inventory close process, the system will create settlements where the first receipt is matched against the first issue, and so on. The settlements and matching principle are based on the financial date of the inventory transactions. A preliminary assessment of settlements and adjustments can be performed by running the inventory recalculation process. Now, let's look at an example of using FIFO without the include physical value option. This first screenshot is a sample set of transactions for a product that is costed using the FIFO inventory model. This screenshot is taken before the inventory close is run. You can see that our 2 issue transactions are costed using the running average value of inventory at the time of posting. After we perform the inventory close process, our financially updated issue transaction is matched to the first receipt, following the FIFO principle. The cost of the issue is adjusted by $6 to a settled cost of $10 to match the receipt transaction. The issue transaction that is only physically updated remains unsettled until it has been financially updated and we perform the next inventory close. When you select the Include Physical Value checkbox along with FIFO for the inventory model on your item model group, the system will include receipts that are only physically updated in the running average and will consider the physical receipts during the inventory close process. To help understand this, let's review an example. In this picture, we show the results of our transaction set when the item model group does not have the Include Physical checkbox option selected. The $25 product receipt is not included in our running average tally used to assign the issue cost of our second sales order transaction, and so the cost at the time of posting is $23. Now, in the bottom picture, we see the same transaction set, but this time the item model does include physical value. And now the $25 receipt is included in the running average posted on our second issue at the time of the update, resulting in a cost of $23.67. In both scenarios, once the invoice is posted on the second sales order and the period is closed, the amount settled will end up being the same. Remember, the inventory close process only settles financially closed receipts and issues. So regardless of our decision to include physical value, the net result of settled cost after closing will be the same value. Now, let's take a look at an example of LIFO, which is last in, first out. When you use LIFO, the newest or last receipts are issued first. Issues from inventory are settled against the last receipts into inventory based on the date of the inventory transaction. The first settlement to be made in this example is the first issue, which matches to the most recent receipt, which occurs 2 days later in this particular example. We continue to move across the issues from the oldest to the newest, so the second settlement is made with the second issue and the second from last receipt. The third settlement happens between the third issue and the third from last receipt. This process would continue on with the remainder of the receipts and issues. You will notice in our diagram that the LIFO model chooses to settle issue transactions against receipts that happened on a later date, which is physically impossible. For example, both items were shipped on 12/1 are getting matched to items that were received on 12/3 and 12/2 respectively. On the next slide, we'll discuss the LIFO date model, which allows us to leverage the LIFO principle, but prevents us from matching issues to receipts that occurred on a later date. LIFO date is an inventory model based on the LIFO principle. Again, issues from inventory are settled against the last receipts into inventory based on the date of the inventory transaction. The key difference between LIFO and LIFO date is that we perform the LIFO principle 1 day at a time rather than for the entire period. In our example here, we apply the LIFO principle to the issues on 12/1 first. You can see that the first issue on 12/1 is settled against the last receipt on 12/1. And the next to last receipt on 12/1 is settled against the second issue that happened on 12/1. Next, the system moves to 12/2, where the last receipt on 12/2, which is the only receipt on this day, is settled against the first one out on 12/2. Then the second issue on 12/2 is settled against the last receipt that is open, which in this case is the very first receipt that happened on 12/1 because there are no other receipts available. This ensures that the issues on 12/1 are matched to the receipts that occurred on or before 12/1. When you use the LIFO date inventory model, if there is no receipt before the issue is settled against any receipts that occur after the date of the issue. It's also important to note that if you have several issues on the same date, they can be settled in the order of the last issue and then the last receipt. Now, let's take a look at some scenarios and decision factors for choosing actual costing. Aside from regulatory requirements that might force an organization to use a specific costing method, actual costing methods are typically preferred when you have costs that change frequently. If the cost of products are increasing or decreasing over time, actual costing will reflect the changes in your cost of goods sold, or COGS, over time as well. Actual costing is also preferred when you set the sales prices based on your cost. You'll want to consider how frequently you update your sales prices based on the speed of your inventory turns and the frequency of the price on your receipts are changing. So let's assume you are a process manufacturer and you track batch numbers on all your inventory and need to draw down the inventory based on batches that are expiring first to ensure that you don't need to dispose of expired inventory. In this case, you're likely using FIFO, or first expired, first out reservations, which is an even more precise method than a simple FIFO method. While FIFO reservations are not a costing method, it does help control the logistical aspect of which transactions are removed from inventory. In this example, you will likely want to also use the financial inventory option on the tracking dimension group for the batch number. Another example here is when you use flow racks in your warehouse for fulfillment. Think about milk in your grocery store. The milk is loaded from the back of the shelf and taken by consumers in the front of the rack through the refrigerator doors. These types of racks are often used in high-turn inventory fulfillment scenarios in warehouses as well, which is very common in process manufacturing, especially for food and other types of commodities. When this is the case, the flow racks help control the logistical removal of inventory in a FIFO methodology, and so it generally makes sense to cost your inventory in this way. Now, let's look at another example of a distributor of goods. It's fairly common that distribution warehouses use front-loading racks where the inventory is loaded and removed from the same side. In this case, the inventory is likely being logistically removed in a LIFO fashion. When the cost increases over the period, there's a tax benefit to using LIFO since you can take a bigger tax deduction. However, not all countries support this type of costing methodology. It's also worth mentioning that when you have slower inventory turns as well, you're more likely to look to use LIFO date to prevent the cost of items from being costed in a sequence that's likely not possible in the logistical handling of your items, meaning that you assign a receipt price to an issue that happened before the receipt of the goods. So let's consider how inventory settlements are made when you use the financial inventory option on the storage dimension group for only the site. This example assumes that a single item is configured to use FIFO. The table on the left shows receipts from day one, and the table on the right shows issues on the next day. On the third day, we run the inventory close. The first settlement is created to match the first issue against the first receipt, which is in a different warehouse. The second settlement is created to match the second issue against the second receipt, which is also in a different warehouse. This process repeats for the third and fourth issues. Now, let's consider what would be different with the same transaction set if we enable the warehouse for financial inventory on the storage dimension group. This time, when we settle the first issue, it is matched to the second receipt because the warehouse must match, and that is the first receipt into warehouse 2. Next, we settle the second issue against the first receipt because it is the first receipt in warehouse 1. You can see that the third and fourth transactions are the same and they match up to the warehouse for the receipt. Now, I'll hand it back over to Anne to talk about average costing.
Thanks, Rachel. Let's look at the different methods of average costing available to us in D365. The first method of average costing that's available to us that we will discuss is weighted average. In this costing method, we post transactions throughout the period at the running average cost, just like we do with FIFO and LIFO. When we close or recalculate inventory, the cost price is adjusted to be the average cost of the period's beginning inventory and any receipts that occurred during the period. All issue transactions in the same period, therefore, will be assigned the same cost. When the inventory close is performed, there are two options for how the settlements can occur: direct settlement and summary settlements. We will show an example of these two options in the next slides. In this example, we have the same transaction set we showed earlier for FIFO, but in this case, the item is set up to use weighted average. After you run the inventory close, you can see that the system has created settlements and adjustments and marked the inventory transactions as fully settled. The sales order transaction has been adjusted to $20.67, which is the average value of all of the financially closed receipts that occurred throughout the period. We did not have any inventory on hand at the beginning of the period, but if we had, its value would have been included in the average calculations. The remaining on-hand inventory from this period will now be assigned a value of $20.67 per unit, which will then impact the cost calculation for the following period. You can see that 2 new inventory transactions were created from closing for the weighted average inventory closing. This is what it looks like when the system uses the summary settlement method. The positive transaction in the set, or the receipt, matches the settled cost of the financially updated issues that occurred during the period. In this case, there is only one sales order that is financially updated, so our weighted average inventory close transaction is valued at $20.67. The negative transaction, or issue, matches the settled cost of the sum of all the financially updated receipts during the period. In this case, there are 3 invoice purchase orders for $10, $22, and $30 respectively, which adds up to the $62 of the weighted average inventory closing record. To close the loop, if we divide the $62 of financially closed inventory receipts by the quantity received, which was 3, that is how we arrive at the $20.67 for our weighted average for this period. The detailed equation for weighted average can be seen below. The weighted average cost is equal to the beginning quantity times the beginning price, plus the sum of each receipt quantity times its receipt price, all divided by the beginning quantity plus the sum of the receipt quantity. When we are using weighted average, the system can also use a direct settlement rather than the summarized settlement we saw in the previous example. The top picture shows 2 inventory transactions before an inventory close is run. There is 1 receipt and 1 issue in the period for the same item, and we did not have any beginning inventory. After you run the inventory close, you will notice that there are no weighted average inventory close transactions created. Instead, we get a direct settlement between the 2 posted transactions, and they are marked fully closed by the system. Direct settlements occur in 2 cases: where there is only 1 receipt transaction in the period with no beginning on-hand inventory, or when there are only issue transactions during the period. The system will automatically determine which settlement method to be used based on the transactions that occurred during the period, so no action is required on the user side. However, it's good to understand that both methods exist when we're analyzing cost calculations done by the system. Our next method of average costing is weighted average date. In this method, transactions are once again posted at the running average during the period, and when we run the inventory close process, the system performs a weighted average calculation for each date within the period individually, where weighted average performs the calculation for the entire period as a whole. This means that all issue transactions on the same date will be assigned the same final cost price, but the price will vary day to day over the period when we use weighted average date. In this graphic, we can see that the system takes the weighted average on 12/1 and will do a summary settlement against the issues because we had multiple receipts. On 12/2, we carry over the remaining inventory at 12/1's weighted average and average that with the value of the receipt for 12/2, performing a summary settlement against the issues. This brings our on-hand inventory balance to 0. On 12/3, we have only 1 receipt and 1 issue, resulting in a direct settlement only for that date. This shows when we use weighted average date, in the same inventory close, we can have both summary and direct settlements for different dates within the period. The final average costing method that we'll look at is moving average. Moving average posts issue costs based on the current average value of inventory at the time of posting. It uses the receipt's physical update costs as the basis for the average calculation, and any discrepancy that occurs with the financial update to the receipt transaction is posted to a special account. We also have the ability with moving average to post a revaluation of on-hand inventory cost if this is needed. In this example shown, our first issue transaction will be posted at the value of the first receipt transaction, since it is the only one we've had so far. The second issue will be posted at the average of any remaining inventory value from the first receipt and the values of the second and third receipts. The third and fourth issues will be posted at the average of the fourth receipt and the other remaining on-hand inventory value. Continuing in the same fashion, we will calculate the cost of the fifth and sixth issues based on the average value of the on-hand at the time of posting each issue. You should notice that we're posting the final costs as transactions occur and not as part of the inventory close process. This is because moving average is a perpetual cost method, which means that issues post with final cost at the time of posting and will not be adjusted at any point. Here you can see a set of inventory transactions in Dynamics 365 for an item that is configured to use moving average. The transaction set is the same example that we showed earlier with FIFO and again with weighted average. This time you will notice that the cost amount used on issues is the running average, and after an inventory close, the settled quantities and amounts are not changed. The value open will remain yes, because this method does not make settlements or update the value open field. Now let's compare some of the key differences between the three average cost models that are available to us. Both weighted average and weighted average date are periodic cost models, which means that they will post at the running average and be settled during closing to the final cost amount. Moving average is perpetual, not periodic, which means that transactions will post with the final cost. When we use weighted average, we will have one issue cost per period. With weighted average date, we'll have one issue cost per day. And with moving average, we could potentially have a different cost for each transaction that is posted. When choosing a cost model to use in D365, we should consider how smooth or how granular we want our average cost to be. Weighted average is the only cost model here which will have receipts on future dates impact the cost of issued transactions. Weighted average date and moving average will only have the cost impacted by transactions that occurred on or before the issue date. This could impact cost reporting, for example, with weighted average. If receipt prices at the end of the period are much higher than the beginning, it'll raise the cost of issues that were posted at the beginning of the period. Just like what LIFO date, weighted average date and moving average only consider past transactions as part of their average calculations. Corrections and backdating of transactions will impact the final cost price for both weighted average and weighted average date, but will not impact the cost price for moving average since it is a perpetual method. Let's look at some real-world examples where different kinds of average costing are used. Average costing is preferred by companies who do not follow a strict FIFO or LIFO flow, but instead issue inventory at a more random manner in the fulfillment lifecycle. Average costing also allows you to smooth product costs over time, where actuals costing can result in higher cost variability. For retail companies, as we've mentioned before, it is very common to use average costing. When deciding between our three options for average costing, we might look at inventory turn frequency. In cases where we have faster inventory turns, we would likely consider using moving average or weighted average date. And when the frequency is much lower, we would think about whether weighted average is more appropriate. We would also think about our transaction volume. For high transaction volumes, the cost of an individual transaction may be less important, and therefore we might want to use moving average. For fewer transactions, we may want to apply weighted average. Let's think about another example where we might use average costing when we're a commodity-based business. Because purchase prices can vary quite frequently, we might want to consider moving average or weighted average date if we want to see the impact of variance on our transactions throughout the period. If we would rather smooth the variance across the entire period, we would look at weighted average. On another note, if you struggle with data accuracy on purchase order receipts or frequently need to backdate postings, we highly recommend that you consider using weighted average date instead of moving average. This leaves you with the ability to correct transactions and have an accurate final cost price. It might seem like we're repeating ourselves a lot on this point, and that's because we are. It's very important to understand the implication of choosing moving average as a cost method. For some businesses, moving average certainly makes a lot of sense to use as a cost model, but all aspects should be considered before making a final decision. As a reminder from our previous Tech Talk, it is not possible to change from moving average to either weighted average model or vice versa after transactions have occurred in the system. Now I'm going to hand it over to Rachel to talk about marking.
Thanks, Anne. Let's dig in and take a look at how marking affects the cost prices in periodic costing models. Marking is a process of tagging a receipt against an issue. There are many scenarios where this happens automatically, such as direct deliveries or intercompany orders, but to make a match, the inventory dimensions must match on both transactions in order to mark two transactions together. For example, they must have the same size, color, style, site, warehouse, and so on. When you use a periodic costing model, such as LIFO, FIFO, or weighted average, the marked transactions override the costing principle, and the cost of the receipt is used for the cost of the issue. If you mark two transactions together before the physical update, the system will automatically use the marked receipt's cost instead of the running average. Likewise, if you link or mark transactions before they are financially updated, the transaction will use the financial cost of the receipt on the issue. If the marking happens after the transactions are financially updated, then the inventory close will make an adjustment to make the receipt and issue costs match. When these adjustments and settlements are created, the system indicates marking in the inventory model principle instead of the costing inventory model that's selected for the item. It's important to note that all inventory models support marking functionality, but not all models use marking to drive actual costing. So let's take a look at our weighted average without the include physical value option where marking is not used. And then we'll look at the same transaction set with marking. The diagram shows receipts on top and issues on bottom. The horizontal dashed line shows the inventory close, and the red diagonal lines show the settlements that are created by the inventory close. You can see in this example that we get a summarized settlement, which is shown in green. This averages all the receipts and settles against the issues. Using the same transaction set, when we use marking instead, the system overrides the logic of the weighted average. In this example, you can see that a solid red line shows a marked transaction. This is the same way a direct settlement would work with weighted average. The inventory close now creates a summarized settlement for the remainder of the transaction. This is shown by the red diagonal lines that are dashed that connect to the green lines after the inventory close. While this is not an exhaustive list of scenarios that use marking by default, there are a number of transaction pairs that are marked automatically by the system. The first example is when you use direct delivery to drop ship items from a vendor on a purchase order to a customer on a sales order. This example makes sense to mark automatically since you know that inventory that was shipped by your vendor was the exact inventory your customer received. So it makes sense to match the costs exactly. Another example is when you use intercompany sales and purchase orders, including intercompany direct delivery orders. In this scenario, unless you have a very high volume of intercompany orders, you likely know which sales are shipping to the other company. Therefore, the cost makes sense to match up. The next example is when you use the option to update order marking when you run master planning. This process automatically updates the production orders against the sales orders that drove the demand and are pegged against the planned production order. If you don't use master planning, but you use the button to create a production order from a sales order on the sales order details page, the marking is also automatically created. This scenario makes a lot of sense in a make-to-order scenario or when your production is a just-in-time model. The accuracy of costing can give you better margins. The last example is the purchase order side of the manufacturing process. If you can realistically issue the raw materials from a specific purchase order to a production order, this option makes a lot of sense to drive the purchase costs into the production orders for the raw materials. When an organization needs actual costing at the most granular level, marking is the best way to achieve this, but comes with the cost of overhead of maintaining the specific relationship between receipts and issues. Additionally, some organizations may give priority to certain customers to receive an allocated portion of the inventory before orders for other customers are fulfilled. When deciding if you should use marking, you'll want to make some considerations. If your organization has special situations where you rush an order or have certain scenarios that have additional cost, like special packaging or handling, or even kitting and bundling, for example, you'll need to consider if the additional cost incurred through manufacturing or handling, for example, should be reflected in the cost of your issue. Remember that marking will match the costs exactly. Keep in mind that marking comes with the overhead of maintaining the relationship if the system cannot mark it automatically. If this is not desired, consider using miscellaneous charges to track the additional costs or using a tracking dimension that is not tracked financially to meet the requirement. Another consideration or example is when you give priority to certain customers. Let's say you allocate the fresher inventory to your best customers so that they have the longest shelf life. If you want to match the costs exactly according to the operations, marking is a great option, but may require a lot of additional overhead to maintain the marking by the order takers. So you may want to consider if you can use batch numbers with a FIFO reservation where the batch number is enabled for financial inventory. But keep in mind, this may not be exact enough and your costs could be inaccurate, which could have an impact where there are big swings up and down in your costs. In our third example, if your organization makes your items to the specification of each customer or only begins the process once an order is placed, you may want to consider marking for actual costing. This is common in highly engineered specialized products or when the item you are producing is very expensive and you don't keep on-hand inventory of the finished goods, for example. Another example where marking might make sense is scenarios where you don't have a high number of customers and you want to track profitability by each customer. This again is common in engineered products and highly specialized inventory. Now I'll hand it back over to Anne.
Thanks, Rachel. Let's switch gears and discuss how default costs are established in D365 supply chain management. When we allow negative financial inventory as a setting and do not include physical value in our running average cost calculation, sometimes we can issue inventory that has only been physically updated on its receipt, but not financially. In this case, the running average cost is actually 0, and it is possible that the system will then post the transaction at a 0 cost. This can also happen if we've enabled physical negative inventory and we've gone physically negative. Posting issues at $0 will result in the balance sheet not being properly updated to reduce the value of inventory. When we close the period, once we're able to settle the financially updated issues and receipts, the system will then adjust the price appropriately if the cost model is periodic. But we still want to avoid posting $0 transactions during the period under generally accepted accounting practices. The way we do this is by using a default cost. We can see in the screenshot on this slide that we issued a total of 5 units in financially updated transactions, but we have only financially updated receipts for a quantity of 4. When the final issue was posted, it was posted at $0 because our financial inventory value at the time was 0. Now let's look at the different ways we can provide a cost when this scenario happens. The default item cost for a released product can be configured in one of 2 ways. Both of these methods will only be used when the running average cost is $0 and will not otherwise impact the cost being calculated based on the inventory model that was configured. The first option is to create an active cost price on the released product. This is the same process as setting a standard cost, but again, when we have an inventory model that is not standard cost, we will only use the active cost price when the running average is 0. It's important to note that the prices configured this way are always configured by site. So if we have multiple sites, we will need multiple costs. The second option is to define a price in the price field on the released product form. This price is only on the product level, so it would not differentiate between different sites or different product variants. We also have the ability to automatically update this price field we just mentioned by enabling the latest cost price flag on the item record. When you enable the Use Latest Cost Price option, the system will automatically overwrite the price each time you post a financial update to a receipt transaction. For a purchase item, this would mean that the price field will be updated each time we post a purchase invoice. The value will be set to the unit cost of that invoice. If you're using product dimensions such as size, color, style, and configuration, you have the additional option, as we mentioned in our previous Tech Talk, to enable a unique cost price by variant. If we set this flag to yes, we would need to use the active cost price method of setting default costs to be able to set a different cost for each product variant if this is a requirement. Because there are multiple ways, as we just described, that you can define a default cost for an item, it's important to understand the fallback sequence. In other words, in which order will these costs be used when there is no running average available at the time of posting? When you use any periodic model of costing, the system will first look to see if there's an active costing version with a standard cost. If there is none, then the system will look to use the item price on the Manage Costs Fast tab in the Release Product Details page. If neither cost is available, the system will use 0 as the issue cost, which we saw in our earlier example. When you use moving average, there is a feature which allows you to set the moving average fallback cost sequence in inventory and warehouse management parameters. This way, you can decide in which order you want the system to look for a cost price. Last issue would use the same cost from the most recently posted issue transaction before inventory went negative. Active cost and item price are the same concepts we discussed in the previous slide. One of the sequence options is to use active cost first and then item price, ignoring last issue completely. This is the recommended setting for businesses who frequently go negative and have a high transaction volume, as it can help mitigate any performance issues from this backup cost calculation. Standard costing does not have a fallback sequence, since an active cost price must exist in order to create transactions on that item. With that, I will hand it back over to Rachel to wrap us up.
Thanks, Anne. Let's take a look at the do's and don'ts to start. For the do's, you'll want to consider local regulations when choosing a cost model. For example, standard cost and LIFO are not accepted everywhere. You'll also want to consider commission calculations when choosing a cost model. Remember, the cost can affect your margins, which is commonly used for these types of calculations. If you calculate your commissions outside of the system, this may not apply. We also highly recommend that you set a default item price for all of your items. Failure to do so can cause these $0 transactions that Anne was just explaining. Next, you'll want to consider enabling financial inventory on the warehouse level if you're using an actuals costing model. We also recommend that you consider the overhead of maintaining manual marking. It can be a lot of clicks for users, and consider the value to the effort that is required to achieve this. Lastly, we do recommend that you consider using LIFO date when you have LIFO requirements. LIFO date creates more realistic results based on your operational movement of physical inventory, and generally makes more sense. Some things not to do. Don't change your cost model without talking to your accountant and auditors. We will find you. Just kidding. Change your costing model without evaluating the cost impact. We talked about this in our previous Tech Talk, but keep in mind that your historical transactions and GL balances will be affected by a change. We also don't recommend that you use moving average if you frequently backdate or correct transactions. Remember, this is not supported, and we recommend weighted average date instead. It's also not recommended to change your costing model after transactions exist. We can't emphasize this one enough. And lastly, don't forget to set your moving average fallback sequence. Failure to do so can cause you to have those $0 transactions. We've pulled together a couple of additional resources. The first link that you see here, which will be available with the PowerPoint and the recording on the Dynamics Tech Talk community page, is the link to part 1. If you missed that, it's also been posted in the chat in the Q&A panel, so you can click on that. We've also got the link back to that cost management homepage. Several of the links that you saw on the earlier pages around FIFO, LIFO, weighted average, and so on have been updated with new examples, more precise information. So we encourage you to check those out. Do join the Yammer group if you're not already a part of that. It's part of the Insider program, where you can connect directly with the product team. And if you've got ideas, we do suggest that you submit those through the ideas site, and that link is provided here on the slide. If you have not already taken the time to complete our survey about additional costing topics, we do ask you to consider doing so at this time. You can find that survey at aka.ms/D365 Costing Tech Talks. Ann and I will be looking those over and figuring out what our next Tech Talks will be, and adding on to this series. And that brings us back to the riddle of the day. The question was, why was the accountant so popular? Ann?
I don't know, Rachel. Why was the accountant so popular?
Because she was the life of the party. I love these riddles. I hope you guys enjoy them as much as we do. We definitely have a lot of fun with these, and hopefully it makes it a little bit more interesting with such a dry topic. And that brings us to our Q&A portion of today's session. So we've got a number of questions that have been submitted, so we'll go ahead and start going through those now.
All right. So, Rachel, the first question says, on all the examples, all the quantities are set to 1. What happens when we have issues that cover more than the purchase quantities? I'll take this one. So we do plan on going into some more concrete examples in a later Tech Talk, probably number 5, where we cover what happens when the quantities are not 1 on every single transaction, which is simplified for example purposes in this Tech Talk. When we have issues that cover more than the purchase quantities is what we talked about in our default cost section. So if we allow physical negative or financial negative inventory, then it's possible that we can issue inventory where we have more issues than the receipts. So we need to set a default cost on the item via the methods we described in order to make sure we don't get a $0 posting. I'll pass this next one to you, Rachel. The question is, can we say that moving average is very similar to floating average?
Yep. Moving average, floating average, running average are all terms that can typically be used interchangeably. They float or they move or they run over time.
Okay. Thanks, Rachel. I'll take this next one. The question was, on the moving average, all of those transactions are financially updated, right? Moving average is different from periodic cost methods. When we post the moving average transactions, they get costed at the value of the physical receipt, not the financial. So you'll notice here, if we look at the physical cost amount posted on our final transaction, it includes that purchase order that's received but not invoiced in the calculation for that transaction. If we have a discrepancy between the physical cost amount and the financial cost amount, that's posted to a separate expense account, which can be defined in our setup parameters, which account we want to use for that. Anything to add there, Rachel?
Nope.
Okay. The next one is, this is a good one. It says, are there any examples of data on the performance of applying one or another costing method?
I mean, we don't generally have like performance benchmarking on like the creation of transactions. And really, in terms of creating a sales order or, any type of issue, you're not going to see a performance impact. I mean, we're talking like fractions of milliseconds for it to figure out what that cost price is. Where you might see a performance difference is in the inventory close process. We're going to talk more about that in part 5 of our Tech Talk series. So kind of what that impact looks like and how to address performance with your inventory close if it's taking too long. But, generally from what I've seen, and Anne, feel free to chime in, the assignment of the cost, like when you're creating transactions kind of throughout the month, is not affected by the method that you choose.
Yep. Okay. The next question, I think that this is about marking, Rachel. It's when we say matching inventory dimensions, which is a requirement for marking to be able to mark 2 transactions together. Does that only matter for financially active dimensions, or is it for all physically and financially active dimensions?
Great question. In terms of matching the cost, it's only for financially active dimensions. So if you've got batch numbers, but they're not activated financially, you could match batch number 1 to batch number 2, and that would be accepted. But if batch is enabled for the financial, you can only match where the batch numbers match.
Okay. The next one, we have a few comments around marking here.
Yeah.
Let's do a clarify on the inventory marking has both cost reasons and physical inventory management reasons that we might use it, right? So just to refresh everyone on that, marking only works as an actual costing approach when we're using a periodic cost method, which is what Rachel said earlier in this Tech Talk. If we're using moving average or standard costs, which are perpetual methods, marking still works for the inventory fulfillment flow side of the functionality, but it does not impact the cost price that will be posted. Right, Rachel?
Correct.
Okay. Do we have any comments about kind of how to handle if we need to remove a system-generated marking, but then we want to reattach it? Is it possible that we might encounter issues with that?
Yeah, it looks like there might be an issue based on the comment that's in here. I would have to test this specific example. As far as I know, there shouldn't be any concern with like removing and reattaching or adding marking where it wasn't generated systematically. There are some scenarios where you can't remove it or that you shouldn't remove it. Some of those system generated ones like direct delivery and intercompany can actually cause other issues if you start removing the marking. And I think some of those scenarios are even restricted to remove marking. So I think we'll have to take that one as something that we test and we'll try to update that in our frequently asked questions or the docs article related to that.
Great. Okay. I'll take this next one. So we have a comment about order marking for MRP in conjunction with advanced warehouse management. I will actually have a customer scenario where the marking can cause more problems than it solves in some cases. So if you're using advanced warehouse management and we have safety stock levels in our warehouse, but and we're going to use marking on the purchase orders for inbound inventory, we could have an issue. Basically, we could have a scenario happen where we didn't get the PO in on time, but we have physical inventory on hand that we could use. But because that warehouse order or production order, et cetera, is marked to a PO that hasn't been received, we can't release work to the warehouse. So sometimes when we go to the granular level of using marking, it can actually hinder us from being flexible with inventory flow in the warehouse. Hopefully that makes sense. Rachel, feel free to add anything.
No, I mean, I think to your point, like the thing to highlight there is the flexibility. Marking is intended to be like a hard reservation. So, and that's kind of what it's doing from a logistical standpoint. Obviously, in some costing methodologies, it also has a cost impact. but you do have to consider the operational or the logistical impact as well. And I think the flexibility is the key there. In some cases, it may be that it's required, and then you might need to look at your operations to see, is there something else you can do in the physical warehouse to kind of make sure that that movement and that hard reservation can be honored. If you need more flexibility, then instead of using marking, I would suggest you look at using reservations rather than a hard marking, which is like a really hard reservation, is like how I like to describe it. So I think you described it well, Anne.
Okay. We had a follow-up to that, which is there a specific reason manual marking can't be used with standard cost? This person has had trouble in the past with some clients.
As far as I know, you should be able to use it. So if you're having a situation where it's not allowed, or you're having UI issues, getting things to mark, it might be that there's a bug, or it might be some combination of settings on your dimension groups that are preventing you from marking. I think Anne and I need to take that as like a follow-up action item. Feel free to shoot us an email with your specific details, and we can try to follow up with you specifically.
Thanks, Rachel. I think it's just to close out the conversation on marking. Marking can add a lot of overhead, especially if you're doing it manually. So just really consider whether it is needed, or whether if you really need actual cost and that's why you're trying to do marking. Think about the other ways we talked about where you can get closer to actual cost, either by using FIFO or LIFO methods, or enabling financial inventory on a batch or serial level, for example. We have a clarifying question around the difference in the product receipt and the product invoice in moving average, the difference in the dates, and then how the main account regarding price difference average will be presented, whether it's in the balance sheet or PL account. So I think this is a really good question. And I think, Rachel, we should add it to our FAQs as a follow-up, unless you have anything.
Definitely.
Okay.
Yeah, I mean, I think high level, right, there are multiple dates on a product receipt and even more dates on an invoice. I think we'll try to make sure that it's really clear, and I don't know them all off the top of my head, like which date is used for exactly what. So we'll try to make sure that the docs and our FAQ are updated with the specific. And then in terms of the price difference, and where those get posted, typically I've seen them go to the P&L, but certainly it's a business decision, and like depending on your accounting kind of situation, it could go to the balance sheet. There's no restriction of what account you select in those accounts, but typically the P&L is what I have seen.
Okay.
I see we've got a question about the fixed receipt price.
Yep.
And someone asked, what is the difference between standard cost? Great question. We actually did cover this in the part 1 of our Tech Talk. So I definitely encourage you to check that out. We had a couple slides where we very specifically talked about fixed receipt price. We're also going to be talking in more detail about standard costing in the next part of our series.
Great. We have a question about which price is used on a customer return. Is it the financial cost amount with the customer invoice of the original sales order, or is it the settled cost amount?
I don't know off the top of my head. Anne, do you?
We'll probably have to test that one and get back. But that's a good question. So we'll make sure that we answer that. Total cost allocation, we have a question about whether that will be discussed. And the answer is yes, we will cover total cost allocation, at least on a high level in session 4, which is all about manufacturing accounting in our series.
No.
Someone else asked, for moving average, what will happen if there's an issue before a receipt? And so again, this can only happen if we allow physical negative inventory which is possible. It's a common scenario in certain occasions for certain customers. We recommend to avoid it as much as possible, but there are real reasons why people may need to use physical negative inventory. And again, that's where we need to have a default cost set for our items, or a fallback, and in some cases our fallback sequence method, so that we can determine what that price should be if we don't have a receipt transaction to tell us what the cost should be.
We're about at the top of the hour here. We are at the top of the hour, so I know we still have a few questions in here. We will continue to review these and try to get these answered. And once we get an FAQ with some of these additional questions answered, we'll let you know what that link is in one of our upcoming Tech Talks. So with that, I'm going to hand it back over to David to wrap us up and do our survey today. Thank you, everyone, for joining. David, over to you.
Thank you, Rachel, and thank you, Anne, for a really great Tech Talk today. I've posted a link to a short survey in the Q&A panel. We'd like your feedback on today's session and hear about what you'd like to see in future events. Thank you for your participation. As a reminder, the recording of today's session will be available on the Tech Talks Community Dynamics page within 5 business days. I'd like to extend a big thank you to our presenters and you, the audience, for joining us today.